All right, everybody. There she is, the woman with the good news from yesterday. And I'm going to start off by just reading a text message that Nicole sent out to her entire text community. If you're not on there, we'll figure out how to get you on there because it's absolutely amazing. But yesterday there was a text that went out that was a little more positive than it's been over the last few years concerning interest rates. So I wanted to bring her on to explain that because I'm certainly not the economic guru. And so, Nicole, thanks so much for popping on.
Oh my gosh, my pleasure. This is always fun. I love my time with you.
Awesome. Cool. So here's the text. The Rueth team is sharing some breaking news. The Fed announced a major shift. They're scaling back their balance sheet reduction, commonly known as quantitative tightening. Translation, less upward pressure on bonds, yields. That likely spells lower rates ahead. Good news for mortgage shoppers and anyone thinking of refinancing. The Fed also kept its policy rate steady, but signaled 2 more rate cuts this year. Investors still think or are expecting 3. Stay tuned. This evolving Fed approach may give buyers some welcome break. So, Nicole, how'd that make you feel yesterday?
I love giving good news. We immediately did a green screen. We sent out the text. We have a text number that you can type the word update to our text number. I'm trying to find it quickly so that I can grab that. But either way, we'll send it to you. We'll post it in the chats after the fact. But to get the news, what Fed Chair Powell talked about and the changes that he made to quantitative tightening absolutely made the difference that we were waiting for. It doesn't mean immediate drop in rates. No, but it means a little less volatility and better interest rates that we're going to be seeing over the rest of this year.
Well, that sounds better than it has been, for sure. And there's a lot of misinformation, kind of people saying the Fed doesn't know what they're doing, what's going on. Yes. You know, since I follow your content and we talk often, I know that honestly, a weakening economy is actually better for interest rates, better for the bond market. So it's not that much of a surprise to me. Obviously, we don't wish hurt upon anyone or, the job loss and all those things. But there is a positive piece of this. And sure, less money in the market at the higher price points. But who's really hurting right now is that first-time home buyer, someone trying to get in, and the cost of everything. Like you did something on condos the other day that, they're just not affordable right now because of the lending practices and all the things that are going into that. I know that you've talked to people I've referred you over with condo disasters on the loan side recently. And so that's just kind of, it's good news for the lower end of the market, which honestly is, where we're seeing the most pain, wouldn't you think?
Agreed. Any relief in the interest rates is going to improve affordability. And when we see a drop of 1%, which a lot of top economists are starting to say that based on the slowing economy, everybody wants a great economy and low interest rates. And that doesn't work that way. And we can talk about why that doesn't work. But with this drop in interest rates, if we see it continue and if we see the economy continue to slide, if we see interest rates hovering closer to 6% than they've been hovering at 7%, that's another 5 million Americans countrywide that start to move into affordability. Now, does that mean that they're all going to buy homes? No, but it does open up opportunities. And with that, we'll see increased demand. We'll see a little bit more of a shift towards multiple bids or sellers getting what they're asking or more competition. All of that helps our real estate market. We've been in a recession for the last 2.5 years. The real estate market has. And now as the economy goes into its version of a recession, which I don't think will be very deep or very long, that's going to kind of catch up the rest of the market to the housing. And housing actually does better during recessions.
Yes. Yes. So that's, kind of where we're going. Obviously a percent of interest rate drop would be absolutely huge, would probably catch, she's talking about bringing people to the market, not to mention the refi market. People locked in those 3-2-1s that are coming to the 1 part or the 0 part of that prediction. But that's absolutely huge for a lot of people that have been waiting for this affordability to kind of come in and do its thing. So that's kind of the prediction piece of it. We don't have a crystal ball, but we'll kind of move forward. So talk about the impact for home buyers as they see that step down, kind of what that means and why maybe waiting till the bottom is probably not the best idea.
So when the Fed came out and they kept the Fed rate the same, so it's sitting right now at 4.25 to 4.5. It's always a quarter point range. But when they started talking about easing quantitative tightening, that really lends to more stability, a little less volatility, probably a shrinking of the mortgage spread as we see the 10-year treasury go down, we'll see the 30-year fix go down and possibly even more so. So all of that is going to help home buyers get more access. Now, if I look at they also put out their projections. So the Fed released a Fed dot plot and they released a projections. So in those projections, they showed that the GDP is slowing down, meaning the economy is softening, the economy is weakening. They showed that unemployment is going up. Again, labor is softening, the economy is weakening. They also showed that inflation is going to stay sticky, but they primarily deflected and said, well, that's due to tariffs. And we think it's temporary. I would argue it's hard to say how an increase in cost on labor and steel and a lot of these other materials is going to be a temporary thing, but that's really, nobody's asking me. So either way,
again, no one's got you on their radar yet.
I don't know. Powell's not got my hotline. I'll have to work on that. But all of this showed their projection also for the Fed rate. Now, the Fed rate, as I just mentioned, is sitting between 4.25 and 4.5. They're expecting 2 Fed rate cuts this year. They're expecting another couple next year, another couple the year after, and they're expecting to land right around 3%. And I'm going to be talking about this. We have an Agent Ignite for real estate agents in my office at 11 a.m. So if you're watching this and you're not on that list, make sure to pop by my office this morning at 11 a.m.
She'll let you in, I promise.
I totally will let you in. Megan and Aller are coming together, and we're going to be diving deeper into this. But for consumers, what this means is if the Fed rate projection over the next 3 years or longer, because that's where their fourth column lands, is a longer category. If they're expecting the Fed rate to go down and they're expecting inflation to eventually go down after this blip of tariff involvement, then what that means is eventually the 30-year fixed will follow suit. Now, the Fed rate and the 30-year fixed are not completely in sync. There's a little bit more volatility. The 30-year fix is much more in alignment with the 10-year treasury, which has more to do with the economy and the inflation reports and the labor reports. Yeah. Bottom line for consumers, that if the estimation is for rates to slowly go down, we've been waiting for this for 2.5, almost 3 years now. We've been waiting for this and everybody keeps talking about it. And for the last couple of years, I've been like, I want it. I just don't see how we're going to get it. Like the economy was still strong. And I kept talking about that. You can't have lower rates in a strong economy. And we kept spending incessantly and we kept maxing out our credit cards and we kept going out to dinner. And now that's all starting to taper. And so now that we're seeing the economy soften, I'm actually thinking we're actually going to see rates start to come down. As a consumer, just know that when this happens, when the economy softens and we see a weakening economy, yes, some people will lose their jobs, and that's wholly unfortunate. But there's 330 million Americans, 184 million of them are working. And so even though we'll have some people being laid off and having to look for alternative employment, we'll have plenty of Americans who were still working, have job security, had been priced out, and now with lower interest rates want to move back into the market. And when that happens, we are going to see increased demand. We are going to see price increases. Every single recession, albeit big or small, except for the biggest housing recession ever, right? Which was caused, the recession was caused by housing. Outside of that one, every recession we see lower interest rates because the economy is softening. We see increased home prices because more people go into a big purchase like a house with lower interest rates. And we see more demand means more competitive bidding, means prices going over for asking. And so right now you're going to get in front of it instead of behind it. You'll get locked in a home purchase price and then still have the flexibility to refinance interest rates when, if, because nothing is guaranteed, they go down.
Right. And so that's leading into the final kind of thought here is there's also opportunity for sellers on the horizon,
Yes.
right? There's a certain price point, 1 million to 1.5, that's absolutely flying. Most other price points are seeing 2 showings a week, right? I did a video on this yesterday, just understanding that one showing is absolutely key to success for sellers when you get it. So for sellers, she's talking multiple bids, she's talking increased prices, maybe getting some of those people that are in homes that necessarily they don't need anymore, that they thought they needed, on the heels of COVID and working from home and all the things. And so there's definitely something out there for sellers as well within this. How do you think that will kind of play out, and kind of what's the timeline you think on how this all kind of comes to fruition from when you see the steady lowering of rates? How long does it take for them to get those mortgage applications in typically?
So we're already seeing, so just yesterday, the mortgage purchase applications came out and it shows a week over week and year over year mortgage purchase application data, as well as refinance data, of course, as well. But we saw a 6% increase week over week. And just the previous week, we saw a 7% increase week over week. So we're starting to pick up, in fact, 7 out of the last 10. So this year, we've seen more positive purchase application data than last year, and even more so than last year's spring over the year before that. So we're seeing this pickup. We're seeing this demand that's coming out of this recession that we've been seeing in the housing market. When I say recession, I don't mean in home prices. I mean in home units sold. Big distinction. We've just seen less sales as we've seen more home sellers hold on to those low interest rates and less buyers that could afford it. But all of this buyer opportunity, we really just need to see mortgage rates head down below 6.5 on a regular basis. We've been hovering around 7. Now we're hovering around 6.75. If we can get to a point to where we're hovering below 6.5, we're going to see mortgage purchase application increase dramatically. And then as it goes to 6%, we're going to see that even more so. Based on the tariffs, based on the economy, based on the GDP projections, there's a number of economists, strong, highly reputable economists, that are now coming out saying that should this tip over into a recession, it is very possible that we could see 6% interest rates by the third quarter of this year. So this spring and this summer, should that happen, could be the best time for a buyer to get in and still get all of those seller concessions to help with the rate buy downs and the closing costs. Because by fall, if that in fact does happen, then we're going to see that favor tip over back to the sellers.
Right. So sellers, maybe a little bit more time on the horizon there to wait to see that, scale tip into, the olden days, so to speak. Hopefully we don't ever get to the 10 to 15 offers ever again. That's pretty stressful for sellers as well.
Yeah,
so
I don't think we'll see that. We won't
as we
see
kind of watch
for
this, one thing you said there was by third quarter. So if buying is on your horizon, if you are somebody that's been on the sidelines waiting, I highly, highly suggest you reach out to Nicole or put her stuff in the comments to get ready for that, right? If you need that rate cut to make, affordability happen, it may be available right now, or you may need the 4, 5, 6 month lead time in order to prepare yourself to have that better credit score, to have the opportunity to take advantage of the lower rate, albeit with probably a little more competition as we go and less inventory as we head into the fall and winter months in Denver. So almost like a perfect storm where we kind of see this brewing, where, the market, the seasonality will kind of have a lot of the inventory that's, high, so to speak, right now scooped up. And then the lower interest rates will have a flood of buyers to the market. And we will probably see, raising costs of homes, which is not the norm really in, our market usually here in Denver. So any parting words to look for here, Nicole?
Yeah, I would definitely say that we're not going to see what we saw in the pandemic, right? To your point, we're not going to see $50,000, $100,000, $200,000 over asking. Now, I will say that there are very specific homes in specific neighborhoods on specific streets that are already seeing multiple bids. When those homes come on the market, There are buyers that have been eagerly waiting for that perfect home. But in general, even if we see rates go to below 6.5% to 6% to even 5.5%, we are going to see more buyers. We are going to see more competition, but it's going to start to feel more normal. It's going to start to feel like we have 2 to 4, maybe 5 offers on a home. Maybe it goes 10,000 or 20,000 over asking. So what I don't want to do is concern buyers who can't get in the market yet for whatever reason. They're waiting for time on their employment. They're waiting to save up a certain amount of money. They're waiting for a situation to change. So I would not be worried in the sense of it is now or never. But if you're in the market and you've been planning on this and you're thinking that the time is right sometime in the next 3 to 6 months, this might be a great time to have a conversation and to look at what it means to you financially to purchase a home this spring or summer before the situation and the environment might change a little bit in the fall.
The best time to talk to a lender is yesterday. The next best time is today. When it comes to purchasing a home, Nicole and I go back and forth on this whole pre-approval thing, but the conversations are absolutely key. And I'll tell you what, they're free, right? So they're free and it's about planning. And, you know, Nicole changed my family's life by just sitting down. I had 2 rentals and 13 months went to 7 doors from 2. And it absolutely has changed our trajectory financially. So if there's anybody you want to talk to about planning and making that happen for you, even if it's the first home or the second or the third, she's your gal. So we'll put her stuff in the comments below. She is always talking about this stuff on her social channels. So make sure you go follow her on YouTube, the Rueth Team, on Instagram, and all the things. So Nicole, thanks so much for your time today.
Oh my goodness. Thank you so much. I'll see you later today.
All right. Bye-bye.
Bye.